There's a moment in every Australian investor's journey that almost no one talks about. It's the stretch between your first $100,000 and your first 500,000. On paper, it sounds like a simple jump. Save more, invest more, repeat. But the truth is, the game completely changes between those two numbers. And most people get blindsided because nobody warned them. When you crossed 100,000, you probably felt proud. You'd sacrificed coffees, packed lunches, picked up side hustles, watched every dollar. Hitting that first six figures takes pure willpower. It's slow, it's grinding, and it's the hardest stage of wealth building in Australia. But here's what changes the second you push past it. Your money starts pulling its own weight. At 100,000 invested in a diversified portfolio earning around 8% a year, you're generating roughly $8,000 annually without lifting a finger. By the time you hit 500,000, that same 8% becomes $40,000 a year. Suddenly the market is doing more for your wealth than your savings rate ever could. To put that in perspective, a full-time worker on the median Australian wage earns roughly $75,000 before tax. A 500,000 portfolio compounding at 8% generates more than half of that, passively, every single year. This is the shift that catches people off guard. From 0 to 100,000, your contributions drive your growth. From 100,000 to 500,000, the market starts taking over. And from 500,000 onward, compounding becomes the main engine. Your job stops being the hero, your portfolio does. But this transition brings new problems most Aussies aren't ready for. The first one is tax. At 100,000 invested, capital gains and dividends barely move the needle on your tax return. At 500,000, they start pushing you into higher brackets. If you're earning a decent salary plus pulling 20 or 30 grand in distributions from ETFs and shares, the ATO becomes your best business partner. That's why structure starts mattering more than stock picks. It's also worth noting that capital gains tax rules in Australia are under active review right now, with the federal government signalling potential changes to how the 50% CGT discount works for personal investors. Whatever the final outcome, the message is the same. The bigger your portfolio gets, the more tax becomes a strategic decision. Stay informed, and don't build your plan around rules that could shift. This is where serious Australian investors begin thinking beyond their personal name. Family trusts, investment companies, and even insurance bonds become real considerations once your portfolio crosses a few $100,000. A discretionary trust lets you stream income to lower taxed family members. A bucket company caps tax at 25 or 30% on retained earnings instead of your marginal rate, which could be 47% including the Medicare levy. Then there's super. If you're a high-income earner, super becomes one of the most powerful wealth tools in the country. Concessional contributions are taxed at just 15% inside super compared to up to 47% outside it. The new Division 296 rules, which started on the 1st of July 2026, add an extra layer of tax for anyone with more than $3 million in super. But here's the thing. Most Australians chasing the 500,000 milestone are nowhere near that cap. So super remains a tax shelter for the vast majority of investors at this stage. Even modest extra concessional contributions made consistently across a decade can add hundreds of thousands of dollars to your retirement balance once tax savings and compounding stack on top of each other. Now let's talk about debt. At 100,000 invested, leverage feels scary. At 500,000, leverage becomes a tool. This is where strategies like debt recycling enter the conversation. The idea is simple. You use the equity in your home loan to invest in income-producing assets, turning non-deductible mortgage debt into tax-deductible investment debt. For someone in the 37 to 47% tax bracket, the tax saving alone can fund part of the strategy. Done properly, debt recycling can shave years off a mortgage while building a serious investment portfolio at the same time. Done poorly, it amplifies losses and creates cash flow stress. The bigger your asset base, the more carefully this needs to be managed. The next thing that changes is your portfolio itself. At 100,000, simplicity wins. One or two diversified ETFs, low fees, regular contributions. That's the playbook, and it works. At 500,000, the cracks start to show. Concentration risk becomes real. If 40% of your portfolio sits in a single Australian index fund, you're heavily exposed to 4 big banks and 2 mining companies. Diversification at this level isn't about adding more funds for the sake of it. It's about making sure no single sector, country, or currency can sink your wealth. Many Aussie investors at this stage start broadening into international shares, hedged and unhedged exposure, listed property infrastructure, and sometimes private credit or alternatives. Not because it's exciting, but because the bigger your portfolio, the more a single bad year hurts. Protecting what you've built becomes just as important as growing it. Your behavior changes too, and this is the part nobody warns you about. At 100,000, a 10% market drop costs you 10 grand. Annoying, but recoverable. At 500,000, that same drop costs you 50 grand. Watching your portfolio fall by the price of a new car can break people who weren't ready for it. This is why the second 400,000 is more psychological than financial. You need conviction, a plan, and the discipline to keep buying when headlines scream that the world is ending. There's also a pressure that builds at this stage. Friends start asking for stock tips. Family members notice you're doing well and assume you've got it all figured out. Social media floods you with influencers promising 30% returns if you just buy their course. The temptation to chase shiny objects, swing trade, or pile into the latest thematic ETF gets stronger the more capital you have to deploy. Almost every blown-up portfolio in Australia started with someone who got bored of doing the boring thing that was already working. Cash flow management also shifts. At 100,000, every spare dollar goes into investments. At 500,000, you start thinking about liquidity. Emergency funds get bigger. Insurance gets reviewed. Estate planning becomes something you actually have to deal with. Wills, binding death nominations on super, powers of attorney. These aren't exciting topics, but at 500,000, you're now responsible for protecting real wealth, not just building it. And here's a truth most people miss. The path from 100,000 to 500,000 is rarely linear. It's not 5 neat 100,000 jumps. You might sit at 180,000 for 2 years, then watch the market run and suddenly find yourself at 320,000. Then a correction wipes off 60,000 in a month. Then dividends, contributions, and a recovery push you to 450,000 within a year. Wealth building in Australia is lumpy. It rewards patience, not perfection. The encouraging part is the timeline gets shorter every step. Going from 100,000 to 200,000 typically takes about half as long as going from 0 to 100,000, assuming consistent contributions and a normal market. Going from 200,000 to 300,000 is faster again. By the time you're working from 400,000 up to 500,000, compounding alone can do most of the heavy lifting in a strong year. This is why the earlier you push past 100,000, the more time the snowball has to roll. So if you're sitting somewhere on this journey right now, here's what to focus on. Get past 100,000 as fast as humanly possible, because that's when momentum begins. Once you're there, shift your attention from saving harder to investing smarter. Look at your structures, your tax position, your debt, and your diversification. And protect your mindset, because the bigger your portfolio gets, the louder the noise becomes. 500,000 is the point where your money starts working harder than you do, where every decision you make compounds for decades, and where financial freedom stops being a dream and starts becoming a math problem you've already solved. If this gave you clarity on where you are and where you're heading, hit the like button, subscribe to the channel, and turn on notifications. Thanks for watching, and I'll see you in the next one.